So then, if we consider the goals of social welfare policy, how can the government intervene to try to address these issues and meet these goals? Well, let us first consider one of the largest federal spending programs, Social Security, basically social insurance for everyone. Social Security began in 1935 with the New Deal, and its goal was to keep elderly individuals out of poverty. This social insurance policy provided cash benefits that were tied to the lifetime earnings of individuals. Basically, the way this is calculated is workers' earnings are reinstated in terms of today's wages to address wage growth. The earnings for the highest 35 years are averaged and divided by the number of months in 35 years to arrive at the average index monthly earnings, or AIM. The Social Security benefit formula then is applied to produce the primary insurance amount, or basically how much the individual will receive in each given month. On average, Social Security provides about 40% replacement income for its beneficiaries, which translates out today to about $1,181 per month, with a max of $2,366. Something to consider, however, is the percent of the income that is replaced with Social Security. Basically, it again provides 40% of the total income. This is interesting today because you often hear people saying that you cannot retire on Social Security. However, if you go back to when Social Security was established in 1935, it was never meant to be a retirement plan. It was only meant to provide social insurance to help you at the end of your life when you go to retire. Individuals were expected to save during their lifetime as well as receive familiar support in their elderly years. Who then is entitled to Social Security? Well, when it was first established, it was meant for elderly individuals. However, we've since increased it over the years for survivors as well as creating disability insurance. But the lion's share of those that are eligible for Social Security are the elderly. You can start claiming at 62, however, there's a significant penalty for doing so. If you claim at 62, you only receive 70% of your benefit. If you wait till 66, you can claim 93% of your benefit. However, you can get that full benefit, your total primary insurance amount, if you wait until age 67. Yet, if you wait a little bit longer, you'll actually receive a further benefit. Waiting to age 68 earns you 108% of your total benefit, and if you wait to age 70, the max, you can receive 132% of your benefit. Thus, for individuals, it essentially pays to wait to retire. Ultimately, because of the cap on the Social Security tax, that is, how much of your money is actually taxed for Social Security, the poor tend to get a greater investment on their wages because they pay so much less because of their low wages at their jobs. Thus, they get a greater return or a larger primary insurance amount than rich individuals do. To help understand this return on investment, we need to understand how we finance Social Security. If we go back to the Lowy Index from prior modules, Social Security is considered a redistributive policy, given that it redistributes funds across generations, or gives from the young to the old. This is a pay-as-you-go or contributory program which is financed by future beneficiaries. Again, the young pay today with the expectation that when they're old in the future, they'll be eligible for that benefit. So how then do we finance it? Well, it's financed through the Federal Insurance Contributions Act, or FICA, which we talked about in prior modules. Employees pay 7.65% of their income at every paycheck, regardless of how much they make. This feeds it into the regressive form of taxation we talked about prior. Of that 7.65%, 1.45 goes into paying for Medicare, whereas 6.2% of it goes into paying for Social Security. We continue to raise the ceiling on it to adjust for inflation, but essentially, there's up to a certain amount of your income, right now $132,900, is taxable by FICA. Anything over that, however, is not touched by it and is not taxed. Thus, wealthy individuals only will pay up to $132,900 in terms of their taxable rate. As such, there is a max primary insurance amount that rich individuals that make over $132,900 will actually get. Thus, the poor, which never will hit that, get a greater return on their investment because they make so low in their wages. We give them more in Social Security than they actually really paid in. Yet Social Security is experiencing the same problem as Medicare due to demographic differences. Basically, the baby boomers are retiring and many are retired and are putting a greater strain on this program. Remember, this is a contributory program. It is financed by workers today, and as such, as the population continues to age, the number of workers that are paying into the system today to pay for retired individuals today, however, is falling. Whereas in the 1950s, we had 16 workers at that point financing every one retired individual. That number is slowly decreasing. The ratio is decreasing to the point where by 2035, we will only have 2 people working today or in the future that will fund every retired individual. As such, future payouts from Social Security will soon exceed the amount of money that's actually coming in from payroll at that point of time. As a result, there will be too few workers paying into the system to actually sustain it. Thus, by 2034, when we get to that 2-to-1 ratio, the Social Security Trust Fund, or the amount of money essentially that we've had in surplus and we've been using to pay for the system, will run out. Beneficiaries can expect about a 21% decrease in benefits. And if you think about that, remember the average beneficiary gets about $1,200 per month. Take away $200 from that. Could you live on $1,000 a month? Especially as you get older, throw in things like increased health costs, and increased cost of living. 21% is a significant amount of money. So then, as policy analysts, we need to ask the question, well, has Social Security actually worked? And then, given these challenges that it's facing, what policies have been proposed to address it? Well, first, economists agree that this has been a very effective and successful program. Remember, the goal was to keep elderly individuals out of poverty. Thus, it's highly effective that economists estimate that it prevents 2 in 5 elderly individuals from falling or living in poverty. Further, it's a highly efficient program. Less than 1%, 0.7% of the total expenditures are actually administrative expenditures. Thus, the vast majority of the money that's paid in is paid directly out to elderly individuals. The program is highly equitable, as all individuals have to pay the FICA tax and are eligible for the program once they reach a certain age. And across all levels of feasibility, the program is well loved by the beneficiaries. Politicians defend it. It is well managed, and we have the technical means to keep the program going. Ultimately, Social Security has been a very successful program.